Now that we've calculated the return of the stock market as measured by S&P 500 index, we are ready to proceed to the next stage, which is to calculate if I invested $1 in a particular year and withdraw in another year, what would be the return. Now we will go back to this table because Excel will extract the right return numbers from this table. So keep this in mind. So the first step is calculate the unadjusted return. Here I do not consider inflation as yet. That will be the next step. Now let's see how it is built. So I'm going to tell you what this model is about. So first of all, on top in yellow is the year of making that $1 investment. So you could invest in any of those years. In here, because of space, I just select year 57 to year 2011. So, and in blue in column here is the year of withdrawal. Okay, so by that definition, you cannot really do anything in the top right triangle here because it just doesn't make sense. You cannot withdraw if you prior you make any investment. But we'll actually take care of that using one formula. So I'm gonna zoom in. So on my Mac, I press Control and Command and scroll my mouse wheel. So let's see. I've selected this simple case in I11, which is I invest in 1957 and withdraw in 58. What's the formula to calculate that? Well, first of all, there's an if statement. If it's A11 and I2, notice that I use $sign to fix the column index for A11. That's because I do not want it to change once I want to use the same formula to other cells. So it will always stay and get the correct year. And the I2, I fixed the row 2. So this exercise we have seen that before. So I'm not going to talk about the usage of absolute referencing here, assuming you already know this. So let's see, first of all, it make a judgment on whether investment year and withdrawal year is the same. So if it's the same, for simplicity, we're going to say 1 because you get your money back. That's it. But if it is not, then we make another judgment. Is it A11, here 58, less than I2, meaning that are you withdrawing before your investment years? If that's the case, then return a empty space. So again, so that's the empty space. Just rule out these scenarios. But if it's not, meaning that you actually strictly greater than, meaning that you withdraw years after you invest, then we do the following. Well, we first of all get your prior year, I10, okay? So go to, this is the base. This is the year, how much money we have left, and times the rate. Now the rate, as you can imagine, there's a 1 here, and you need to do a VLOOKUP. So the VLOOKUP basically grab this index A11 and go to my S&P spreadsheet, and this is the range containing the returns, and grab the third column. Let's do a double check. VLOOKUP S&P. So indeed, the third column, if we match the year, and would give the third column, which is the year-over-year return. Here I notice that you actually lose money, and therefore go back to this spreadsheet. Actually, you lost a little bit of money if you do that. The next video will show you how do we adjust for inflation.